All right, I think we are good to go. So I'm going to take a look at some of the pairs that you guys listed out. The request was from Patrick and Brett for EURUSD 4-hour, 15-minute to the 4-hour, but as usual, I'm going to start with the monthly. Just give us a quick glance, figure out what's the macro cycle. Macro cycle, remember we've been hung up on this center line for a while with these candles right here. We're starting to break short of that. So now we're breaking down into this previous range down here that wasn't really well received. As you can see, that price action was taken and pushed higher, obviously, ultimately overall. So it'd be interesting. We're going to see some major volatility when we get in these previous wick ranges right here. The question is, are we going to get pushed to the bottom of the overall cycle? So where is the bottom of the overall cycle? Liquidity down here. That would be where there's a strong magnetic pull for the market's hunger for liquidity would be down here at that low. So I wouldn't be surprised. Again, I can't tell the future. I'm not making predictions. I'm just telling you different ideas to look for as they pan out. Would be the market getting sucked down to that level overall. This is a monthly time frame, so that can happen in one candle, or that can take 6 months, or crawl down over the course of the next 12 months. I really don't know. That's just going to be based on how many eyeballs are trading this market and watching it, and how strong their opinions are being formed about what's going to happen, and that will eventually, control the speed of things. So anyway, that's one thing I would look at. I would definitely look to the short side, even though we have been, really. I always say this, guys, from a purely technical standpoint, you guys want to get interested in these markets close to expansion, right here. This is where you wanted to really get interested in markets. If something breaks out on the monthly or the weekly or even the daily, right here is where volatility is coming into the market on higher time frames. So hopefully you guys, especially guys that have been with us for a while, you're starting to pick up on that pattern, because that's all about timing and being early to a move. Because this has provided you, like many markets, has provided you how many months, from up here down to here, you have, we're talking like 7-8 months of down movement. So if you know that, going with even what Shane was covering, if you're understanding, if you're seeing a clear signal that's very understandable on the higher time frames, that goes a long way into simplifying your analysis on the lower time frames. What gets confusing is when you get fully drawn into the lower time frame, because then there's patterns all over those charts. There's long patterns, there's short patterns. It's like almost at any given time, you can find some way to justify going long or short, depending on how you're looking at the market. And then at that point, you end up with a 50-50 scenario. Yeah, it'll go up, it'll go down. So starting with the higher time frame gives you that slight bump to one side or the other. Am I going to be mostly long, or am I going to be mostly short, or am I going to be all long or all short, which is really, in my opinion, ends up being the best policy. In this 7-8 months right here, you had to do nothing but, while those candles stay yellow, all you had to do is figure out how to sell the market effectively. Where's the liquidity on your lower time frames? Watch the expansion patterns, watch the lower time frame cycles, and everything with a short bias. You literally erase your buy button on your screen, like put a piece of tape over it so you can't see it. But that's really the whole entire purpose of directional bias, is so that you have the ability to do that. And that's what ends up stacking the odds in your favor. If you guys ever know, I've probably made this, I don't want to get too caught on this, and I'm not a gambler, but there is similarities like in roulette, where, because you can actually basically have 100% win rate in roulette if you just always always double your bet to equal more than, or always bet more than you've lost up until that point, and just keep betting on black or betting on red. It's called the Martingale system, and you can do that. And some people have tried to do that in trading. They try to figure out ways. The problem is that if you lose a handful of times, all of a sudden your bets are enormous. And if you have an unlimited funding, and you got to think that what banks are controlling the world. They basically have unlimited funding. So I think they're actually able to trade like this and get away with it, because if they lose all their money, the government will just give them some to replace it, which has been proven. Think 2008. So anyway, not to get too lost on that, but my point, I'm coming to a point here, so give me a sec. The point is that you can actually win on roulette with that, because typically it's 50, it's almost 50-50 odds, besides there's one green slot on the board. So if it hits that slightly throws off 50-50. But everything else is just black and red, and you double every time. So my point is, what ends up happening is that if you're running the Martingale system, you'll win a bunch of times in a row, but eventually it'll go on a run where you'll get 8, 9, 10, 15 blacks in a row, or 15 reds. And if you're betting the opposite, you're done, because your bets again become so enormous. And then just something with casinos know this, that's why they have a table limit. You can only bet so much. So like, let's say the table limit is $1,000 bet, then eventually you'll be maxed out and you've lost so much that you can't even bet more to make it up. So it's a scary game, and I'm not recommending anybody do this. I'm just telling you that it is a strategy sometimes people do. But the point I'm coming around to is that this right here, you can think of this as that streak. If somebody's only betting long and they keep adding to a bad trade, they saw something up here that made them think, oh, this market's going long, and they ignore the momentum of the higher time frame, and they keep, let's say they're not even looking at the monthly, let's say they were looking at the daily or the 4 hour, and they buy, and it goes against them, and they're like, no, it's gonna come around, and they buy, and they buy again, and they buy, and they buy, and they buy, and they buy. The problem with that is a lot of times the market will come around, because the markets do range, but the times that they don't is like that Martingale system failing, and it carries you away, like this did right here, where it'll wipe you out. And that's, like I said, it's the equivalent of getting 15 blacks in a row or 15 reds in a row, which does happen. You'd think, how could that happen when it's almost 50-50? It does happen. The same thing happens with a quarter flip. It's been proven. There's studies about it. So anyway, that's the importance. When you catch something early that has the ability to trend one way on your higher time frame, like the weekly and the monthly, that is significant information, even to apply to the 15 into the 4 hour. If you apply that to the 15 and the 4 hour, then you know that if the monthly and the weekly and the daily are all generally trending one way, then the 4 hour that aligns with that direction, you want to pay more attention to than when it doesn't. So that's my whole point with this. So I told you I was getting there, and hopefully, I'm sure a number of you have heard me say that before, but those of you that are new, I just think that there's power in simplicity, and this is one of those simple things that if you can look for it and be ready for it, it will really, really aid you and be forgiving, even when you have bad entry. If you're running in that overall macro trend, it'll come around and save you quite a few times. Even if the trend is coming to an end, you'll come back to those lower centers of gravity, those lower time frame value lines, just because you have so much momentum pushing in that direction. So anyway, that's all I'm going to say about that. So the monthly's going down. I told you that story to tell you that story. It's going down. So weekly is obviously going to be a representative of that. You guys see right here, you have these weeklies right here that were not long enough to turn the monthly direction. You had one push down right here. You will get these fake outs, but overall, a lot of people saw that, went long right here. But again, until the monthly rotates and you see blue on that monthly, it's all going short, all of it. So if you know that and you can spot that, these are all opportunities to stay short. So weekly's headed down. We are at an untouched gray box, so keep in mind there as you work down a trend, you do want to look off to the left side of the chart and figure out what the benchmark prices are, because you have to work down through these levels and be ready for them. So always keep that in mind. But as long as the higher time frame is supporting the direction, you will drill down through all of them through the course of that higher time frame trend. So keep that in mind. Jump down to the daily. Okay, the daily has sold off. Volatility hit the daily. We knew that back here. Remember, guys, we're coming out of this cycle. This was a new range cycle coming through here. Swing high, swing low. So 1, 2, 3, 4, 5, barely a fifth expansion leg right there, and 6. Now the 6th one is starting to show itself to be the more trending movement. Right here, this gray box, you want to look at these boxes as a family of boxes giving you a big picture of information. These are telling you not only do we have contraction areas, but we have 1, 2, 3 leg expansion pointing back to these areas right here. So that tells you that you're in a multi-leg expansion altogether. So that tells you what to possibly expect through here. We had those classic multi-leg expansion whips that came out of that, but eventually those will end. This gray box right here breaking out to the short side, this is something that you possibly would, consider jumping in on if you're trading the daily time frame. Why would you buy or sell the breakout right here? Because in the context of that, we just had a swing high breakthrough that got rejected. An aggressive break short out of that is nothing more than fulfilling a down expansion leg, or has a probability of doing that. So, but this by itself, it's always scary to buy breakouts. But again, put in the context of this, that's a direct breakout expansion. And that's just fulfilling what has started over here already. A lot of you guys, especially the ones that watch the videos on the YouTube channel, they say, what about the boxes that just break out? They think that every contraction has to have a multi-leg expansion, like a funneling out. They think it has to have that, otherwise it's not the master pattern. Well, you have different types of expansions. The definition of expansion is simply leaving the box. That's when we know that the market has contracted and now it's expanded. And now it's either going to do one of two things. It's going to go into a multi-leg expansion, meaning it breaks the high and then the low of the box, or it's going to go into a direct breakout expansion, meaning it doesn't break the high or the low and it just goes and then you form another box at higher or lower prices. How you know the probability or what's likely to happen is looking at the context of the prior boxes. Again, this box, just looking at it by itself, if you're looking for, okay, here's a box, now it has to have that 1-2 leg break on the box, then you're gonna be frustrated. But if you look at it in the context of all the other boxes, it all starts to make sense with the big picture, especially when you combine it with the monthly. All of these expansion legs all had short biases. Never once are you getting, if you're trading the daily into the monthly or going, if you have spotted that monthly direction, never once that do you enter a situation where you go long in here. Remember, if you have that directional bias and you've spotted that where that heavy momentum is, and especially if you're early to it, every single time it goes against that momentum, you're trying to figure out what is the most effective way I can enter that momentum. So none of these blue candles become opportunity to buy. That's what I'm saying. Now on the lower time frames, if you're trading like a 15 and a daily, that's a different time frame. But even those become more risky. You could see that the downside of these, because the monthly was short, were much better. So again, that's what I'm saying. Even if you're trading the lower time frames, by spotting that bigger time frame momentum, you know the side that you want. Even if you're trading these long, which I know some of you will, you have a much bigger expectation of the short side of the market than you do of the long side of the market. So anyway, hopefully I'm kind of rambling on basics here, but guys, the basics are so important. They're so important, and a lot of you guys that struggle ignore the basics. If you have something on the higher time frame that is giving you that advantage of simple information, you want to use that. That simplicity is what really carries through. And again, if you really spotted that monthly early, you're talking about the possibility, depending on your money management, and that's your guys' business, but depending on your money management style, potentially had 0 losing trades in 7 months so far. So you can see that there's definitely power in understanding that simple information. So it is still hard. You still got to enter the market. You got to hang it out there, and that's something that everyone has to deal with. But as you can see, go back and study monthly charts and see what kind of information that would have given you, how it would have kept you on the right side of the market more times than not. So especially if you're clean after expansion. Now, once we've already gone through, especially you're starting to oversell the expansion index, Now this has shown us that this move, it's not that it can't keep going, but now this move from this expansion point, which is this box, is now above normal. And that's why we're starting to get a pause. That's what this expansion index is. It's a measurement tool. It's a measurement of volatility. And these white lines tell you when something is within normal. You can see all this stuff right here. None of this pushed the expansion index out of the range. So all these things just came back to value in the middle of the range. Now the minute that, and I'm not saying you can't, because you have to start trading it this way. But if you catch one of these legs, if you're looking at the overall context and you've been able to ride this down, now you know that you're above normal. So if you've managed to sell this market up, breaking out of this box and got that trade placement, and you've taken it all the way down to here, this signal right here is telling you, don't get greedy. You've captured an above normal move to the short side. How do you know it's above normal? Again, because this is measuring what's normal and what isn't. So that above normal movement to the downside, it's telling you right now that if you booked profit from here to there, you should pat yourself on the back. You've pretty much knocked it out of the park, because based off of the measurements, this is out of the money that moves this market and the percentage that it likes to move. You've gotten some major meat out of the middle. Now, like I said, it can keep going. It could do whatever it wants. So all we could do is take measurements off of the past volatility. So, but this is real-time measurements according to what's happened on expansions. So it is pretty accurate that way. So anyway, covering a lot of basics. I'm sorry, guys. I really like to drill down on these every once in a while. I feel it's important. Now that it's going short, let's jump down to the 4 hour. And we were going to look at the 4 hour into the 15. Now the 4 hour has just expanded. So what does that mean? That means that the daily time frame and the weekly time frames, if you want to reinforce the 4 hour, look to the daily and the weekly to see what happens with those next. Because the minute you break the high or low on the 4 hour, I would say immediately the daily time frames, the weekly time frames, all the way up to the monthly time frames start to become engaged again. Those time frames stay in the market longer. And if they stay in the market longer, that means it adds stability to the trends. That's the whole point. When you get a multi-leg expansion, what that actually means is that the higher time frames haven't become interested enough to sustain a direction. So the minute you get a 1-2 expansion, that potentially, not all the time 100%, but what it means that the higher time frames haven't taken the bait yet. And that's especially apparent after you've had a big move. If you get that 1-2 expansion and you don't break the low of the trend, that's the whole point of in the way Shane and Andrew explained the finding the new range master pattern origination point. It's a simple sequence event. You've had a move from lower to higher prices or higher to lower prices, and now you have a 1-2 expansion leg that didn't push the trend. So we're expecting just naturally an end to the trend. We're expecting that, right? But what's going to be an indicator that we're there? That's going to be that 1-2 expansion that doesn't push the trend and starts a box red. And if you don't have the higher time frames taking the bait, every time it breaks a higher low of the multi-leg expansion, everything comes back to value, to that new box range. And that's why those new ranges become so magnetic, is because the higher time frames simply aren't pushing the trend yet. They will, but not yet. And that's what gives you guys that market maker rich dealing range. That's a perfect place to do two-way business for market makers. They crave that area. They purposely drive the markets to those areas where they can do that two-way business because it's gravy. There's so much spread commission to be able to make and manage their own book of business. And they know as long as price is coming back to value, they can liquidate their negative selection portfolio at those value levels. That's why you get rejections like this. This is liquidating a negative selection portfolio. Market makers see the market going up. They see it crawling up. They drive price back down to value because they know they'll get people to start selling the market. They liquidate their negative selection portfolio, which is the positions they don't want to have, and boom, it moves up. When you're in a two-way dealing or a two-way dealing range, that's rich for this market maker activity. And this is why people get so destroyed in the range, because they just don't understand the type of business that's being done in that situation. So anyway, the 4-hour broke out and that's calling those higher time frames. So the next question that you guys trading Euro USD 15 into the 4-hour need to ask is, are the higher time frames going to take the bait? The best way to know if they're taking the bait is to look at them. So I would look at the 4-hour and I would reinforce that with the daily. Now, to combine that with the daily, what's the overall directional bias? Monthly is still short. So if the daily, if you get a breakout on the 4-hour right now, this is testing the daily to see if the daily holders are going to start going long. They're going to start buying the market or closing out short positions. Same thing, right? If that doesn't happen, because the daily has to fight the monthly still, if that doesn't happen, this is coming down probably to the low of the box. So you can say that if this comes around, the 15 starts coming around, you get new boxes. Let's say you start stacking red boxes to the short side. It starts giving you those clues that, hey, we're not pushing longer. And you see the 4-hour turn yellow. Now you're in line with the daily and the monthly. The daily buyers didn't take the bait. They had the chance right here. Not to say they won't later, but there's a possibility for a low risk entry to the short side. You're above value on the 4-hour. You at least come back down into value and see what happens. Because at the end of the day, it's risk management and trying to get a strong entry. That's where you're at right now. Now you might say, well, we're above the, value on the 4-hour. Can I trade it long? Yeah, you can. Absolutely. You could do whatever you want as long as you have tight risk management. But what ends up happening is that a lot of you guys end up getting in the market, you take a position and you expect everything to just run and run and run. And ATS will put you into the money with strong positions, but not every direction of the market is going to run like you would like it to. So that's where it's definitely a good idea to take a look at the higher time frames. You know, like I said, you could have traded this daily long right here, this little one candle. You might be like, this is a turn, I'm going to trade it back to value right here. But problem is, this didn't turn the monthly. And unless that monthly turns, it's all going short, all of it. So right here, much more interesting, much more interesting, right? And those are the ones that you have the possibility that you might want to let run. Again, easier said than done, I know, but that's trading. We're just trying to stack those little percentages of probability above 50-50. So, and these are those little clues that would help you do that. So that's what I think about Euro USD 15-minute. No entry right now to long or short. You may want to short this if you think this is the last liquidity grab on the 15. I would say if you're really confident in the 4-hour, if you want to trade the 4-hour going short, I'm not telling you guys what to do. You could technically control risk above the liquidity line right here, and then your benchmark price would be getting down through this value right here, and then you're probably off to the races to the short side. If you do get down through this value, you want to start, once price starts establishing itself below that level right here, then you can bring your stop loss down and start protecting the profits that you have. That would be one scenario, but I would probably personally rather see this become yellow on the 4-hour first. And then even if you don't get the absolute perfect entry, this is one of those situations where I would probably favor confirmation over perfect entry. That's it. Let's take a look at pound USD, and I'm going to go through that much faster, but hopefully there was some decent lessons for you guys in there. Interesting what's going on here for the monthly. Again, looking at these boxes together, what kind of picture are we painting? Right here, I see a predominant red box right here. That's basically giving us a range to deal in, right? So we had swing high, swing low. Now we didn't get through the swing high. That can be an indication that we're done going higher. So buying the breakout on this box, pound USD monthly, remember what happened on Euro USD. In fact, let's just look at it real quick. And remember, I can't predict the future, but all you can do is start looking at the signals and trying to find risk-controlled entries into an idea. What happened right here? We broke short. Same thing right here. We had multi-leg expansion coming out of here, had the chance to keep trending higher, and it didn't reject. So now we got a direct breakout expansion so far, It could turn into multi-leg if it swings high. Anything could happen. But as of right now, we had a direct breakout to the short side at the high above value. So there was a decent chance we're at least going to cover this gap right here. Now let's go back to pound USD. Does that look similar? Does that look similar right now? So what's the questions that we need to ask right now? We got to look at the context. Say, do I think that there's strong momentum that could come into the short side? I think so. I think we're above value. I think this is the point to look at right here. This is the market framework that is giving the best information as far as true value on the monthly. This is a highly gravitational price level. So question is, do I think price over the coming months can gap from here to here at least? Okay. Second question, do I think price can get to here and then get through here down to the swing low? So that is the speculation. This is the coming up with an idea. Do I think that that can happen? That's a question right now, is that we need to figure out if the higher time frames are going to take the bait. If they're going to take the bait, of course, there's monthly is kind of the highest typical chart frame. Now we're really talking about macroeconomics above the monthly. You're going to have to watch the monthly closely and just kind of figure out, what is this aligning with the overall macroeconomic situation that you think is likely to play out, would be probably your best indicator. Anyway, that being said, jumping down to the weekly. Okay, what's happening here? Okay, we had red box, you know, had the chance to keep pushing this trend. We have a gray box, minor framework, but what's up with these two things right here? You have these up days testing. This was technically, if we take this market back, let's forget that happened right there. Okay, if you only were looking at this, you have red box stacking. Now you're below value. Could you have bought right here on the weekly chart based on kind of a basic strategy approach? Yeah, you'd want to look at more of the context. I mean, this wasn't the best because we had a pretty heavy dealing range coming through here. You got two red boxes, basically at the same price levels, and a minor framework right here. That shows you that this is pretty market maker rich price point right there. So that is something you want to take into consideration. But let's not worry about that for the second, or for this moment. Right here, this right here could have been a possibility to buy in what you felt at the time was long momentum. But what happened? What happened right here? Attempt 1, rejection off value. Attempt 2, rejection off value. Even a third attempt, rejection off minor framework value. Push to the low side. 3 times you had a chance to get up through here. So these are the kind of clues that can cue you into trend isn't taking. And those are those clues that the higher time frames are starting to liquidate. They're not going for it. And if that's the case, you're coming back. Where are you coming back to? Probably down here, either to these points, which we're kind of at right now, or probably ultimately maybe down to the low here, or the low of the entire range down here. So based on what's happening on the monthly, I would pay a lot of attention to the downside of these weekly candles based on the overall context. Now let's jump down to the daily. Okay, same thing on the daily. One blue candle here, and we're just ripping short. Now we've just come down through liquidity, but again, you know, I would pay attention. You know, one thing that you guys could do, if you want to find things that are against the monthly, if you really like that, the idea of trading in line with the macro timeframes, you can literally pull up your assistant, and right here on your TF1, you can set your entry time frame to whatever you want, but find things that where you have set your TF1 as a daily and set your TF2 as a monthly, and you don't even need to run any signals. But basically, if they're red, like, let me just do this real quick. So looking at these right here, all these, if you're looking for those few days that are against the monthly, remember, unless the monthly turns, the future of these days are going back in trend with the monthly. So like Frank Yen right here, you have a daily to a monthly that's red. So what's that's telling us is that, and remember, the TF1 does lag by 1 candle. So this is not real time on TF1. but more than likely you could go through these ones. You know that you have divergence between the daily and the monthly time frames, but the monthly's stronger. So these could be, if you're looking to catch those daily rotations back in trend with the macro time frame, you just look at these ones that are red. And I know some of you guys will look at those, that means don't trade. Not necessarily. That means that those things are out of alignment. What happens with things that are out of alignment? Eventually they come back into alignment. So that's a simple way to use ATS Assistant to spot things that are diverging, but you know that they potentially have a bias to one side in favor of the monthly. So in these situations, you might want to go look at these pairs and study the monthly. Study what that looks like. Where is it in its cycle? Is it like pound USD just breaking short and you have a daily that's out of whack? You know, that signal, looking at that red, that would have been red right here on this, well, after this daily. So on the opening of this day, you would have had the red because it does lag by that one candle on TF1. But that still would have alerted you to here, you know, to that situation. So again, those are things that just those simple little things can help you to clue you into some of this stuff. So, and that's why we left ATS Assistant so kind of wide open to program, because people use it in different ways to find certain situations that really resonate with them and that they understand. And that's why there's so many different ways to use it. Anyway, so that's pound USD. It's headed short. Let me jump over to the 4 hour. And I think the time frame that was asked was 4 hour into the 5. So let's look at the 5 minute. Okay, so we have a couple of blue candles here, but again, the daily is still short. So remember, unless the daily turns blue, what's the future of these? They're coming back yellow. So that being said, everything overvalued on the 5 minute is a sucker's play. Everything. Right here, right here, right here, right here, right here. All of it's coming back into the dealing range. Because why is that? You've had a big run down too. And not to say it can't reverse. There's one of these things out of these, if you're trading short in this dealing range, one of them, if it is a reversal, because they do happen, eventually markets turn, you're going to get caught. It's going to snap you. It's going to take some of your money. So you need to be prepared for that. But as long as you're running decent money management, you're not choking off every little trade, you know, every time it goes 2 pips against you, everything's coming back into the dealing range because the market makers love this area. That's why you're getting price action like this. You've had all these expansions on the 5 minute, and none of the higher time frames, including the hour, the 4 hour, have taken the bait to any significant degree. So, you know, we have had a pretty big run here. I wouldn't be surprised if we don't take a decent breath on the daily. So keep that in mind. I wouldn't hang it all out there at this point. You really wanted to hang it out there right here. That was pretty beautiful. You know, right here was good, especially because the macro timeframes were already starting to head short. But, you know, that's doesn't mean you still can't trade. Just be careful. You know, use smaller position sizes. Be creative. Use multiple positions so you could build a position because you're mostly not going to get the entry perfect. So you want to be flexible to be able to take advantage even if the market goes against you, but you're still in overall criteria of the directional bias.